Hello and welcome to the Blockchain Academic Podcast by the Crypto Research Report, decrypting the world of crypto assets, focusing on insights and analysis from the top minds in crypto today. Brought to you in partnership with the premium sponsors of the Crypto Research Report, Coinfinity, Incrementum and Falcon Bank.
Today we're talking with Dr. Usman Chohan, who is the Director of Economics at the Center for Aerospace and Security Studies in Pakistan. Recently, he wrote a paper entitled, Are Stablecoins Stable? And we wanted to go ahead and discuss this paper with you because I think that you have a lot of good insights about fundamental problems with currency pegs, and you discuss whether blockchain can help those fundamental problems or not. So to go ahead and get started, how did a director of economics at a center that focuses on aerospace and security studies become interested in stablecoins?
Well, my main focus is on trying to find solutions to the tricky problems about financial regulation, financial sustainability, and cryptocurrencies. I've always had a personal interest, but in terms of financial regulation, you're starting to find that more and more of the traditional financial regulatory agencies, such as the Financial Action Task Force, the Securities and Exchange Commission in the US, and so forth, are interested in this asset class as well. So there's more of a merger that's exogenous. It wasn't my choice. The personal interest was always there. And for stablecoins, I think it's one of those weird places that traditional fiat money and cryptocurrencies are finding an awkward arrangement. It's not a permanent arrangement. And so it's fun to talk about it. I know that you have a personal interest in it too. So it's an area where we can try to figure out if this even works for traditional fiat currencies and cryptocurrencies to find some medial space of interaction.
Interesting. And basically, so you're based in Pakistan, is that correct?
That's correct.
And how is it on the ground in regards to cryptocurrencies? Are people using cryptocurrencies? Are they talking about cryptocurrencies? What cryptocurrencies are interesting for them? Or is it really just not part of the discussion?
This is one of those countries where the state bank, so the equivalent of the Federal Reserve, said about 3 years ago that they don't want to touch this with a 10-foot pole. It's one of the first countries to say there's going to be no business. But I believe that that was not so much their personal outlook as it was pressure from abroad. And the reason was that there was a lot of pressure on the country, basically using anti-money laundering, counter-terrorist financing type discourse to pressurize the country economically to sanction it. So in order to try to appease foreign regulatory agencies, such as including the IMF and then the Financial Action Task Force, the state bank said that we're just not going to touch this stuff because there's always been this fear with cryptocurrencies that they could be used for nefarious purposes. It was, I believe, more common back then in 2017. The recent information we're getting is that that sort of activity is declining, but you can never make a concrete, even remotely make an accurate guess on this kind of thing. So I think that the reason the conversation here has been mooted is because of exogenous pressure rather than people's interest. I mean, you'll always see people in the forums being interested in this stuff, but as far as the regulatory part goes, it's not one of those places where you see the kind of budding conversation that you've seen in, some countries such as Japan or Australia. No.
So just to understand this correctly, are cryptocurrencies legal or illegal in Pakistan?
I think their use is entirely illegal. Possession, trading, all the functions, utility, etc., are
Okay.
illegal.
So with a law like that, then basically there's not a lot of room for businesses to innovate because they're not allowed to engage in the business. So it's fascinating that there's still research being done on the topic. And so I think that this is an important conversation, basically to discuss what cryptocurrencies can add to the table, as far as monetary policy goes. So to get into your paper, you discuss currency pegs. Has Pakistan had a currency peg in the past?
It has, and it's always kept it in a bandwidth. Always meaning that over the past 50 odd years, it's tried in various periods to maintain some level of pegged relationship to the major reserve currency, the US dollar. Up until 2019, the bandwidth was about 100 to 1. And then there was so much pressure on the current account and the other deficits that the country faced that the IMF pressured, the International Monetary Fund pressured it to let go of that. It fell to 150 from 100. And so you can see the trauma that caused, but it tended to stabilize after that. And so right now it's trading between 150 and 160. If you look at the historical rupee dollar exchange rate, when I was a kid, so in the late 80s, it was about 10 to 1. And over my lifetime, I'm in my early 30s, it's gone from 10 to 1 to 150 to 1 in kind of spurts. Bam, 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 whenever some big crisis happened or something.
Okay, so since Pakistan has an experience with currency pegs, and since you've also studied them, in this paper you discuss some of the difficulties with constructing pegs to traditional currencies. What are some of those difficulties?
Well, there's two types. If you want to look at it in a summary fashion, the idea for a peg is that you must have trust and credibility. That's one. And the second is supply of the foreign currency. So when you keep a peg to a major reserve currency, you must have enough of it on hand to justify the movements. Otherwise, there's always a currency speculation element. A lot of people can make a lot of money by proving you wrong if you are the monetary authority, proving you wrong and seeing you devalue to break the peg. Now, the Thai baht is the classic example. This led to the Asian financial crisis in 1997, and several countries, in addition to Thailand, collapsed simultaneously. But it was the baht that was not able to preserve its peg. Similarly, in 1992, the infamy of George Soros as an investor came from his attack on the pound. And so the Bank of England tried to maintain the peg, ultimately realizing that it simply wasn't worth it and let the pound fall. And Soros made £1 billion worth or more out of that trade. So there's always the risk of attack. And if you can't back it up with trust or credibility, the peg ultimately collapses. I can't think of a single peg that has stood the test of time indefinitely. For example, I always thought the Swiss franc was a strong peg, but in 2005 it unraveled. And so pegging itself is an effort to bring stability in the relationship between two monetary instruments. But if you can actually keep that indefinitely, is always a challenge, even in traditional, let alone cryptocurrencies.
Definitely, yeah. I think the peg was 2015, the Swiss franc to euro when it broke. But it's a great point. I mean, I've also studied the pegs, and I think the only example I found of a successful peg that the monetary authorities didn't leave because of distress was the China's peg to the U.S. dollar, which I think they had for I don't know exactly. I think it was for 2 decades, and they left it in the 90s. And that was the only one where it wasn't a crisis of confidence that kind of forced them to leave the peg, but it was more of like a decision that now we're ready to leave the peg. But every other one, like you say, has been a loss of trust, a loss of credibility, and then it opens up the currency to speculative attacks. I think it's a great point. I think some things can help the credibility. For example, the one you gave with George Soros, it was basically apparent that the Central Bank of England, the Bank of England, they didn't have enough foreign reserves to keep propping up the pound. And when investors realize that, they can speculate on shorting the currency and hoping that there's a devaluation, and then they can profit. So I think that's a great point, and I do think there are some ways that blockchain can help with credibility, in the sense that if you can show people your reserves in a transparent way, maybe that could help in store trust. Do you see any ways that blockchain can help overcome these issues, or do you think that blockchain will not help people keep currency pegs?
I think that this is still an open question. I see your point about the transparency being a source of strength. With China, you brought up a good point that that is a strong peg that did last. Ultimately, it was deliberately brought down. Hank Paulson, the former Treasury Secretary, in his book dealing with China, has brought up a lot of how this happened. He because it was actually a negotiated process. But actually, China faced a very serious problem in the early 90s, around 1992 to 94. So there was still that pressure there. It's just that it wasn't left to the mercy of the currency speculators. So acting in advance helped, but deliberate action is important. With cryptocurrencies, it depends how you structure the peg that really matters. We can get into the collateralization element at a next step, but the ultimate thing is, what is your peg really against? So is your peg against a basket of foreign currencies? Is it against an asset like gold? Or is it against a basket of cryptocurrencies? So depending on what you are positioning yourself in relation to is the first big question. And you see, like Digix is an example pegged to gold. Then you have Tether, which is to the USDT, and then other variants. And so what is the relationship that you're trying to construct is the first question, because then you have to acquire that asset in sufficient supply if you are attempting to collateralize.
Definitely. I like in your paper that you discuss these different types of collateral, and then you also discuss that the collateral can be full, partial, and non-existent. It can be uncollateralized. So there's different types of collateral, and then there's different backings, like quantity levels that the collateral takes. So,
Mm,
for example, like full collateral, this would be potentially a gold-backed stablecoin like Digix. I think Digix
mm,
is supposed to be fully collateralized, basically.
mm-hmm,
Um, and then there's partial, which people could argue might be Tether. Um,
mm,
and then there's uncollateralized, which was the big basis coin, which didn't make
mm,
it to the market in the end.
exactly. So with full collateralization and partial collateralization, the big ask with full is that you really must have that much, if not more. So when you, for example, have a peg between your instrument and other cryptocurrencies, you actually have to hold more than full. You actually have to own 150% or more. That's the practitioner experience, that you have to own more than 100% of the cryptocurrencies, just because the volatility between them is so high. So then even 100 isn't good enough. You have to go to 150 or 200% off the cryptocurrencies. With fiat, obviously, it's a wide market, large amounts in circulation. So even owning one-to-one is a lot, but then that holds you to a limitation that you can only issue a supply equivalent to how much you hold. That in turn depends on how many people are adopting your currency, so putting money against your instrument to then give you that to work against the peg. Now, if you are really that popular, then you have actually already solved the problem that these stable coins were meant to solve, which was the volatility in cryptocurrencies. So if you have so many participants in your stable coin, you might as well be a cryptocurrency itself, not being pegged to anything, because then you have already decreased the volatility so much with so many people involved. Currently, we don't have that volume of people engaging in the market. It's not deep enough as an asset class. So that's the paradox with that. If it were stable enough, then you wouldn't really need it to be stable. You wouldn't be pegging it to anything. You see my point?
I do. I mean, that's an interesting take. I think just to counter that, I think if we look at gold, for example, gold has been on the market for thousands of years. It has a large
Mm,
network of users. Um, and gold is relatively stable compared to other
mm,
asset classes, but uh, it's still not completely stable. There's still volatility in the price of gold, and even I think that even if we get a cryptocurrency like Bitcoin with a network as large as gold's, I still think
mm,
that we would have volatility because there was a paper by Robert Sams in 2014 that argued that part of Bitcoin's demand and part of the volatile cryptocurrency demand comes from speculators. And
mm,
if the cryptocurrency itself becomes stable, then you're going to have the speculators that will leave that market, which will then cause a drop in the price because there's less demand for that asset, and then
mm,
speculators will enter again because there's this opportunity again, and there'll always be this movement of speculators in and out of the market.
Mm-mm.
which can also cause volatility. So I think that even if we got a cryptocurrency to be as large as gold, it still might not be the right a volatile cryptocurrency. It still might not be the right conduit for a unit of account.
Mm.
Do you see anything with that, or do you think that it's really possible, this dream that a lot of cryptocurrency investors have, that eventually with a large enough market, you could have a volatile cryptocurrency become stable without a peg?
Mm, yes, I think you make an excellent point. I think the paper you cited is a very important one in this case as well. I think we're talking about two different elements or magnitudes of volatility. You can always anticipate volatility because of the argument you brought up that they will leave and then they will see that there is an opportunity, so they'll come back in and so on. But that degree of volatility would not be as dramatic as we have experienced over the past 5 to 10 years in cryptocurrencies because that is simply too large, and that actually motivated people to develop stable coins. And so my point is that if you have a stable enough cryptocurrency, then stable coins is basically just a coin. You've already solved the problem, so you don't need to initiate stable coin type architecture of pegging and all that effort if they are already stable enough. So yes, you're right that there'll be volatility. It's just that perhaps the volatility wouldn't be as dramatic as it's been so far.
Yeah, that's. I mean, it'll be interesting to see how the markets develop over the next couple of years.
Mm,
An,
mm,
another point that you made in your paper, which I hadn't thought of yet, was that I think you write somewhere that having full collateral is a problem for scalability. And
mm.
I hadn't thought about that yet, but can you discuss that idea more?
Yes, it speaks to the point that if you need that much collateral with you, you will have trouble growing because, for example, if USDT right now is approximately 300 million, right? So then you need to have $300 million ish. Or if you have a billion, then you would need a billion ish. So fully collateral means it's a 1 for 1 or nearly 1 to 1. And so then you really need to have that kind of assets. And if you don't, then you're going into a different category. You're going into partial, which opens up a different can of worms. But if you really have to be full collateralized, then scalability becomes a problem. You really do need people to adopt it at those grand scales to have that reserve to back up your peg. That's the problem.
Yeah, exactly. It's fascinating. So there's many different dimensions of the stability, because you could have stability in a small kind of closed network, but if you want to open it up to the whole economy, it maybe that same model won't work anymore. So
Hmm.
it's fascinating. I mean, one thing with Facebook's Libra was that if they were going to back that currency with a basket of fiat currencies, my
Mhm.
my thought was always that this is a great thing for America, Canada, England, and the euro, and I think it was also the Japanese yen that were going to be in the basket. I can't recall all the currencies that were going to be in there, but basically the current global large currencies. And I thought that this was a great um, way for these global currencies to survive, because nobody's really interested in buying the bonds of these heavily indebted countries that are offering low interest rates. And
Mm.
if they had a global currency like Libra that was now people in India or China or Pakistan or Brazil could use that currency, wouldn't this be a kind of transfer of household savings from these developing countries to the developed countries?
That's a very good point. Accessibility would be a problem that Libra would, in theory, solve. It would democratize the financial system. But there are a lot of vested interests in the current financial system as it stands. My experience with the Financial Action Task Force has shown that there's almost mafia behavior where they try to sanction countries and then put them in boxes, and then they deliberately want the people of those countries not to access the global financial system. And so there's a monetary authority power issue here because central banks do coordinate very well amongst themselves. We saw that in 2008. It was driven by the Fed, and then other people jumped on the bandwagon. And so they managed the fallout of 2008 and 2009 quite well by coordination. But that doesn't mean everybody gets to join that club. So that's the issue with having a current architecture of power, they would see that Facebook, which is an unaccountable authority as well, just as they are, monetary authorities are generally independent authorities. They're not elected and they don't address the values of the public directly through an electoral mandate. Neither does Facebook. So in the competition between the state and the market, the fear is that this would empower the market so much compared to the state that in those few realms where even non-elected independent bodies that still belong in the architecture of the state would not be able to exercise the level of power that they have in the past. I think that's a big fear behind it. But as far as your argument goes about accessibility and democratization globally, I think that's one of the things that got lost in this debate, because a lot of the debate around Libra was framed in terms of congressional testimony. So there were these high-fly Silicon Valley guys representing Facebook appearing in front of congressmen. So the thing in mind, the basis of the conversation was the US dollar and the US's power over monetary authority in international markets, particularly in terms of it remaining the reserve currency. But now the question is, given the current state of the world economy, does the reserve currency status of the United States dollar actually makes sense when so much activity is happening outside? You see, because that's why there's the exorbitant privilege, as it was coined by a French official back in the 40s, that it's going to cost the US too much to have its reserve currency status, because it'll be used abroad more than it would be domestically. So other people will always want more US dollar than is used domestically, and so it will continuously run deficits. That's why you see the culmination of that problem, for 70 years later, with Trump attacking China and all these other countries in terms of trying to fix the deficit, because the reserve country it's a very expensive, exorbitant privilege to have that. So I think that the state power, to put it more simply, the state power element is what really prevented Libra from assuming that mantle.
Yeah, it's a fascinating, excellent discussion. I think I was reading something about something called the Triffin dilemma, which was trying to discuss when you are the reserve currency of the world, you run these deficits because the whole world wants your currency, and you're constantly buying goods and services from the rest of the world and shipping them dollars. And then what happens in the Triffin dilemma argument is that you locally in the domestic country that has the reserve currency, you actually stop building things. You don't build industry anymore. You don't build cars. You don't manufacture steel. You don't do any of that stuff anymore, because your basic export now is your currency. And I don't know, I haven't studied it a lot, but I think that Britain also suffered a similar uh, it is a privilege in some ways, but it's also a big burden on the local people that live in the country that can't make anything anymore. I mean, because they're buying stuff from other countries nonstop. So I think it's interesting if thinking about the dollar hegemony and the pound hegemony and potentially the next hegemony, is it good, for a country to have this status? I think Keynes wrote about this Bancor unit, because I think that he also saw this as being a problem for economies. So I wonder if it really is such a great thing for a country to have the reserve currency in the long run.
Well, the Triffin dilemma is essentially that problem of short-term objectives versus long-term objectives. That's basic. So I'm glad you mentioned that. In the long run, is it good? Well, in the long run, it's not. But your short-term objectives and the exercise of power in the short run is certainly manifested best through having the reserve currency. In the long run, it doesn't quite work out, and that's you summarized it really well. So that's also why the Bancor, as you mentioned, was never materialized. So Keynes was very eager after the termination of World War II to have a multilateral currency that would be protected and issued by the World Bank, similar to what the special drawing rights actually did end up at the IMF, but something much stronger and something that circulates much more. It wouldn't just be an exclusive right to draw money, it would actually be something floating about. But his US counterpart at the time, Harry Dexter White, basically threw him out of the office and said, this is our time now. You've had your time, you British colonialists. Actually, the US was actually very anti-colonial at the time. It's a very different personality from what it has today. But back then, Harry Dexter White said, get the hell out of my office, because now it's the US's turn to have that kind of fun. So it was very much looking at the ashes of World War II, and now it's been almost 80 years since that time has lapsed, and now a new architecture includes emerging markets and other players and private interests such as Facebook, as well as cryptocurrencies. So diversity of the global financial architecture cannot be captured by any one currency, and any currency is ultimately the reflection of its constituent economic agents as parts. So that's why you see the problem with the US reflecting, first of all, its use abroad, the US dollar's use abroad, as well as US economic productivity, which is the sum of Idaho and California, for example. So California is very dynamic, but Idaho perhaps not. Similarly, the euro is the combination, the aggregate of Germany and Greece, or Holland and Spain, very different countries, very different essences of dynamism, very different roles. And this is where the idea of surplus recycling becomes very important. The way that the global system has worked, you alluded to this earlier, that it would be a transfer from developing countries to developed countries. The reality of global economics over the last 80 years has been very much from developing to developed. But the mask that has been put above it is foreign aid. Oh, let's help out these poor people in Africa, etc. But in the reality, a lot of the resource of the developing world has gone to the developed world. And what we needed instead after World War II, and this is what John Maynard Keynes also foresaw, was that there has to be a sustainable recycling mechanism so that the deficits countries take the surplus region's output, but give something back. And so there's a kind of flow from, for example, you see surplus recycling mechanisms from cities into the countryside, or the core countries to the periphery. But if you have only the surplus countries accumulating more and more surpluses, then the disparity between them and the deficit countries grows too wide. That's why you see countries that are rich are getting richer. Countries that are poor are they're worse off today than they were when they became independent. And in the meantime, inequalities within countries are becoming more exacerbated. So this is the problem with the current financial architecture, which inspired people who are true ideologues of crypto anarchism to promote cryptocurrencies as decentralized areas where there's autonomous participation of the individual, protecting their digital identity. These are the sorts of problems of inequality, injustice, and all that they try to address through a new cyber architecture, right? The reserve currency is being so massively produced recently with Corona. The Fed is backing it with 1.5 trillion. It was 0.8 trillion in 2008. There's so many dollars out there that the dollars you hold are worth less in comparative terms. Now, with many countries, including Pakistan, they're moving away from the US dollar as much as possible. So, for example, here, the largest trading partner is China. And now there is a swap system that's managed through the respective central banks. So the state bank here and the people's bank there. And so you can swap yuan for rupee. Russia and China have done the same. Other countries are also doing it. So the ruble and the yuan are the most proactive in this to find alternatives outside of the US dollar. But there is one trade that is enforced through military power today that makes it impossible for countries with the current technologies we use to move entirely away from the dollar, and that's the petrodollar trade. So Saudi Arabia and other countries accept nearly exclusively the US dollar for their petrol exports. Because of that, because we're still so reliant on traditional energy sources which are non-renewable, including oil, this is the problem we face, that if we do need to buy oil, and a country like Pakistan is a net importer of oil, it comes up to more than 20% of our import bill. So for us, then having to have enough dollars to pay the big Gulf countries, particularly Saudi Arabia, for that in dollars becomes an issue. And that's why there is a legitimate need for dollars in the current system. So until we have renewable energy, one, and two, the petrodollar is broken, you can't really get away from it. But the fact that the petrodollar cannot be broken is one of the reasons why basically the global, that would explain a lot of how the economic history over the last 50 years has evolved. For example, the oil shocks that occurred, talking between 70 and the 80s, and then the glut, and then right now, as we speak, Russia and Saudi Arabia are on a race to the bottom in terms of the oil price. You're seeing that oil has a big explanatory factor because it is such an important factor of production in the modern industrial society. And just like cryptocurrencies, non-renewable energies offer a vision for the way forward. But until it is adopted on a wider scale, just like non-renewables being adopted on a wider scale, cryptocurrencies not being adopted on a wider scale holds us back to an outdated and outmoded structure where certain poles of power continue to reproduce their class power. So that's a bit of a Marxian analysis behind this. But until those things, non-renewable and cryptocurrencies and other elements to move forward with greater adoption, you will continue to see the same problems occurring.
Yeah, kind of. I like how you explained that the petrodollar is basically what's keeping the dollar alive globally, and it makes a lot of sense because if the petrodollar is the kind of linchpin, then it explains why any country in the Middle East that has oil that tried to move away from the dollar was such a big obstacle the last couple decades for America.
Mm-hmm.
So I think that's also a good point. Um, this is fascinating talk, and we could talk for hours. Before we finish up, just to come back a little bit more to your paper, we we discussed how scalability is not really possible with a fully collateralized coin. I mean, it can be possible, but it has certain challenges. And then you also discuss a model where there's no collateral. So you basically rely on these crypto bonds, which I found very interesting in your paper because you actually explain the mechanisms behind it. And you also explain why probably it would end in default. So can you just describe how that would work?
Yeah, absolutely. I think I when I wrote this, I foresaw it as a theoretical thing, based on the traditional architecture of fixed income instruments, bonds. But actually, more and more countries are interested in this. One example is China is interested in issuing a crypto bond, and the other is the World Bank has kind of commissioned the Commonwealth Bank of Australia, which is a private bank, to produce that. But those are basically bonds on the blockchain. And a crypto bond is something different that I had in mind, which was basically a kind of instrument that you would issue to maintain a peg without having any collateral. And so what you would do is issue versions or denominations or fixed income instruments from your pegged crypto instrument out, and then you would pay something in terms of either coin or something else to those issuers to then pay off anything required to maintain the peg, right? But the thing is, there would be so much risk involved. If you look at how the psychology behind fixed income works, they trade at a premium or a discount. Well, since there would be so much risk involved, and since it's uncollateralized, you would have to emit or issue the fixed income instrument, the crypto bond, at below par value. So that's how you would then anticipate a price rise later on, as there were more people buying it, then that discount would probably achieve something closer to its par value. And future earned income through issuances would be what would pay it in the meantime. So that would already exacerbate even more risk. So future issuances would have to be at an even greater discount. So then you would be assuming that you have to grow very fast in order to maintain this sort of system. And that's why I worry, because it's very similar to how emerging market fixed income instruments that would be rated like low B's, C's, or junk, that's how they behave too. And so you have a cycle of debt that's created. And at some point, the buck has to stop somewhere because there's nothing truly behind it, nothing backing it up, the full faith and credit or the supply. And so people then expect discount, discount, discount until it becomes junk status. And so what I did is try to juxtapose how the problems in emerging market traditional finance fixed income might occur with a kind of pegged, tethered cryptocurrency that didn't have any collateral to back itself up. That's the thinking behind this.
Okay, so yeah, there was another paper that I interviewed the author of a couple days ago, Yaroslav Kuznetsov, and he called this model seigniorage shares, which I thought was a good name.
Mm.
And so basically, like as you mentioned, if I can understand this correctly, the idea is that you're backed by nothing. You have a stable coin on the market that's, let's say, backed to a dollar, pegged to the dollar, and if the price of the stablecoin in terms of the dollar starts to decrease and depreciates, what you want to do is you would want to remove coins off of the market in order to make that currency supply lower, so that there's ceteris paribus, that the price goes back to the target range for that currency.
Mm.
And in order to to do that, you would need to issue crypto bonds to the market. And this would basically be let me understand this correctly. So this would be a liability from the issuing company, and it would be an asset on the side of the investor, and the investor would be sending coins to the issuer. So that would be the on the issuer side, the asset side would be the new coins that they brought in. On the liability side, it would be the bond that they issued, and then that would try to get the coin back into stable area, into the target range. But now, if that business can't generate profits from somewhere else, in order for them to pay people to incentivize them to hold on to the bond, they can either, like you said, issue the bond at a discount, or they could try to pay them a yield or some kind of combination of the two. So
Mhm.
if they don't have any profits from anywhere else, then they can't really effectively incentivize people financially to take on this risk.
Mm. Yeah, absolutely. I think that's a very good summary of it. The idea of adjusting the money supply of your coin and issuing crypto bonds are not necessarily related. So, for example, you have algorithmic processes in theory and in practice now, where you have a smart contract type arrangement. So the algorithm then can adjust more or less of the coins out there, which is buy them. And so that's a separate mechanism. But the issue of when you have an uncollateralized, you're not backed by something that is a standard or traditional instrument, and you still want to engage as a stable coin with that instrument, then you have to emit some sort of security. And the likeliest would be fixed income. So these are two separate mechanisms. They don't have to occur together, but you've summarized the crypto bond element of it really well.
Okay, fascinating. So to go ahead and finish this up, looking at all the different models that we discussed today, do you have a favorite? Do you see one that's going to be better for the market than others, or might be adopted quicker than others? Where do you see the market going?
In the long run, I see stablecoins as possibly a redundant solution, just because I would anticipate that in the long run, more and more people would be involved, and so a wider and deeper capital market behind your traditional, excuse me, your larger cryptocurrencies. And so many people are involved, you don't need to have this bridge between traditional finance and cryptocurrencies. So ideally, stablecoins would become redundant in the long term. I see this as a kind of intermediary step. As cryptocurrencies have grown, they've piqued the interest of many people, but there's still a lot of doubts about how it's going to work, because people have not gotten. We've been in societies with our structures of power for so long that it's difficult to imagine a world and a society where decentralized systems might be possible, even though they are. That's the spirit of anarchism, crypto anarchism behind this, because it assumes, or as it was beautifully put in a history of anarchism published in 2009, it's demanding the impossible. It's demanding the impossible from people because it assumes that people would come to mutual aid out of a common interest, but live autonomous lives. And that's the same in the crypto domain, that people would own these assets, but they would exercise their own autonomy, protect their privacy, and engage as free individuals in cyberspace. So Tether is a kind of translation device into traditional finance, which does not operate in that manner. There are structures of power, there's structures of monetary authority that manage things very differently. And so this is a kind of intermediary language. In the long run, we wouldn't need these things because enough people grow that trust, and enough goodness, that anarchist goodness that's anticipated, happens in cryptocurrency domain, that these things are not required anymore. They become an asset class on their own, and that is large and deep, and so you don't require these kinds of intermediary steps anymore.
Well, Dr. Usman Chohan, I think that's a wonderful motivational speech for the whole entire cryptocurrency market, and also just very fascinating to hear that you feel that stablecoins are just a step into the wider, more decentralized, public permissionless cryptocurrency market. I think it's fascinating. Well, thank you so much, Dr. Chohan, for coming on today. And if people want to follow up with you, find your work, where can they find you?
I tend to publish my stuff open source on the Social Science Research Network. I guess it's just a Google away, and I tend to be very easy to access. Otherwise, the Center for Aerospace and Security Studies publishes my work regularly, and I hope that the projects that you're undertaking, the crypto report and so on, these help to reassure those people out there who remain on the fringe or who have been traumatized by previous falls that there is still a horizon ahead for these things to evolve. And the last word has not been said either on anarchism or on cryptocurrencies. So there's a way forward.
Thank you so much for coming on.
Thank you.
Thank you for listening to the Blockchain Academic Podcast by the Crypto Research Report. We hope you found this episode to be informative. Thank you to our premium sponsors, Coinfinity, Incrementum, and Falcon Bank. For more professional financial analysis of cryptocurrencies, blockchain technology, and the weekly Crypto Research Portfolio newsletter, please visit the website cryptoresearch.report.